To your point, I think last week or the week prior, I think the Mexico tariffs were a huge distraction. And I think that when it comes back to this period where we are now, we're continuing to see accommodation from not only from the Fed, but you saw comments out of the ECB, out of the BOJ last week. We have more tools. We will use them. I continue to think that the market is fueled on the basis of the fact that we're going to continue to have accommodative monetary policy and liquidity being provided to the markets. I think that the equity markets are overstating the benefit that a rate cut will give to them in the back half of the year. They're understating the amount that the point that the economy slowing would be why you would get a rate cut, and not because the Fed is overly supportive of asset markets as it relates to equities. And so I think right now we're back to this story of accommodative policy. We're back to the story of where else do you go with your money? You don't
unless you don't think the economy is really slowing as bad as some feared, and you get a preemptive rate cut of sorts from the Fed to make up for the mistake that some say they made in December. That's like the best of both. I mean, they're cutting rates and the economy is actually doing pretty well. What's wrong with that picture? What's bearish about that?
But I think if you look at
whether you believe they should do it or not,
the growth expectations for the next couple of years continue to come down. You're looking at across the board. So I don't know how the market can continue to factor in a continued rise in equity prices when we're expecting growth to continue to slow.
Okay, so Joe, it's not necessarily just sentiment that's improved. MKM has an interesting note out today. They look at their technical strategy. JC O'Hara over there says the internals are firming up in the market as well. The market is just looking better if you look across the whole thing. They say a surge in the ratio of advancing to declining volume has historically been a good indication that the market is ready to push higher. They say on June 4th, the AD ratio was 18-1, the strongest reading since January 4th. Then you had on Thursday, that last week, 16% of the S&P made new highs, the strongest reading since January of 18. Okay. That says internals are better. Market is primed to go higher.
Scott, I think we could all see that, though, with the market up 5.5% for the month. I think that goes to Josh's points. We're reacting to the last 3 or 4 days. I would love to have that note this time last Monday. That would have been a valuable time to have it. I think we're making a mistake here. We're talking about the market, okay? And I think what the lesson so far of late 2018 and 2019 is this. There's a high correlation between what Federal Reserve intended policy may or may not be and these high momentum, mega cap type of names in the marketplace. And those are the names that are reacting and are getting whipsawed all over the place. When you're looking at your portfolio and all these asset classes, again, high yield, investment grade, they did not flinch. High quality momentum names like a Microsoft, like a McDonald's, like a Motorola Solutions, they have held firm. So I think you have to look at that and say, okay, now looking forward and understanding we're taking the headline off the table, whether we believed it was ever going to be there or not with Mexico. We've got a potential rate cut. Where's the sensitivity if the market continues to move higher? And for me, it's possibly the emerging markets.